Before we get into today's sponsored episode, I want to frame this conversation in a way that might challenge how you think about investing. Most people approach wealth building with one question: how do I make more? Higher returns, bigger deals, more leverage, faster growth. But that's the wrong question with today's guest. If you look at every major financial collapse from 2008 to today's rising interest rate environment, the people who got hurt weren't the ones who aimed too low. They were the ones who took on too much risk chasing upside. So here's the better question: how do you build wealth in a way that you don't lose it? That's what this episode is really about. Today's guest, Joel Friedland of Brit Properties, has spent over 4 decades investing in industrial real estate, buying more than 100 buildings. But what makes his approach different and honestly pretty contrarian is this: he uses zero debt, focusing on only one niche, and he builds for long-term durability, not short-term gains. This is a strategy designed not to win in the best of times, but to survive any time. Now, a quick note before we dive in. This is a sponsored episode, but as always, the goal here is to extract ideas, frameworks, and strategies that you can apply to your own life and investing decisions. So as you listen, I want you to think about your own portfolio, your own income, your own strategy, and ask yourself, is this what I'm building designed for growth or for survival? Because the investors who last the longest aren't the ones who swing the hardest, they're the ones who stay in the game. So let's get into it. Before we begin, quick disclaimer: nothing in this episode should be considered investment advice. Results discussed have not been independently vetted. Any claims made by the guests have not been verified. The content is for educational purposes only. Views expressed by the guests do not reflect those of the host or this show. Hey guys, welcome to another episode of the Financial Freedom Podcast. I've got a great guest for today's sponsored episode, Joel Friedland from Chicago. He's from Brit Properties. He's going to talk about his investment firm portfolio. Main strategy is no debt. I'm really happy to have him on. Joel, welcome.
Christopher, thank you. It's nice to be with you.
Briefly introduce yourself. We'll dive into the questions.
I am a Chicago industrial real estate investor and syndicator. Been doing this for 44 years. I'm 66. I started when I was 22. A lot of people you hear went into various things, trying single family homes, read a book and said, I got to go into real estate. Graduated from the University of Michigan and went to work for a family that owned hundreds of millions of dollars worth of industrial real estate, became a leasing agent, learned the business. And they taught me how to be a syndicator. It was great. I started syndicating when I was 30. I've bought 108 industrial buildings. The crazy thing is that we do our deals these days with zero debt.
Talk about the average investor who comes to work with you. What is their avatar? Why would they come to work with you?
We deal with people who are extremely wealthy and are not looking to make a lot of money. They're looking not to lose their money. Our investors are all kinds of people from different backgrounds: doctors, lawyers, accountants, people who sold their company. I have a very specific group of investors. They are highly risk averse, extremely wealthy, and don't want any bullshit. They don't want somebody who's a salesman. They want to get to know me. It's all about trust. I build long-term relationships with my investors who go back all the way to the 1980s who still invest with me. I've got new investors who, when they go in, they want to talk to some of my old investors just to get a reference and a feel for it. I've got this community of investors. There's a really nice relationship with them.
What is your investment strategy? What types of properties do you invest in?
We buy buildings in the Chicago area only. We only buy buildings under 30,000 square feet, industrial, primarily manufacturing buildings, no multifamily, no retail, no office, just industrial. And that's all I've done for 44 years. And picture grandfather who started a company in the 1950s manufacturing parts for tractors. Chicago has 16,000 industrial buildings. Of those 16,000, half of them are occupied by family businesses that manufacture or distribute products. We buy those buildings. Grandpa started the business in the 1950s. The kids came in the business and ran it. They make millions of dollars, sell the business, and now they're in the next generation. The grandchildren were running the company. They don't get along so well with each other. Maybe when Grandpa was running it, he kept the peace, but Grandpa dies, and now you got all these cousins who own these buildings where they no longer own the tenant because they sold the company. We buy those buildings and we lease them to the companies that make the products that manufacture. We have manufacturers of different kinds of food products, protein bars, pumps and motors, metal parts that are made using the plastics industry. Those manufacturers are our tenants, and they move in and they never move out. It's too expensive to move their equipment. So we have these leases. We have a building that we bought in 1990, and we've only had 3 tenants since 1990. So in 36 years, that means they stay an average of 12 years, and the rent goes up every year. Our strategy is to find those buildings off market, buy them from the family, keep them leased, and distribute cash flow for the long term. 108 buildings, $300 million worth. Very specific. My wife had pancreas cancer 2 years ago. She survived it. We went to the most experienced, highly regarded pancreas cancer surgeon in Milwaukee, Doug Evans. All he does is pancreas cancer. We trust him because he's great at that. People who go with me say, you only do industrial, you only do buildings under 30,000 square feet, only in the Chicago area, only companies that have good financial statements, so you're going to get paid rent, and debt-free. They say, okay, this is what Joel does. I like to consider myself like the Doug Evans of industrial real estate syndications. When people meet me and we get together, my existing investors, we talk about things, either it turns somebody off right away or it turns them on to the point where they say, okay, I must hear more. Tell me how and why you do it. They know what I do. It's not a mystery. I'm not trying to do a little of this and the next shiny object. We buy buildings debt-free. The whole point is for cash flow and for the long term. I'm not against anybody using debt. It's great if someone else uses debt. I'm not against somebody else doing deals not in their own town. I'm not against people doing deals in different kinds of real estate. But for me and for my group, we're super specific. Industrial, debt-free, small building, Chicago only.
Quick pause here. If this episode is making you rethink how your income is structured, that's intentional. Information doesn't create freedom, structure does. At the end of this episode, I'm going to show you how to diagnose whether you're building leverage or just scaling complexity. Let's get back into it. You talk about the benefits of durable, risk-aware investment model, and you talk about off-market, tenant resilience, investor alignment, proven and durable model. Elaborate on this for the people that are listening.
We find buildings by walking around in industrial parks. I have a group of people, myself, and we go to the industrial parks where there might be 200 buildings, go door to door, ask for the owner and say, would you like to sell your building? Last year, we bought 7. We found 4 of them by knocking on doors in industrial parks. The durability is, I'll give you one example. We bought a building from 2 twin sisters. It's 10,000 square feet, bought it for $1,300,000. Their dad started the business, built this building in 1987. When I walked in, said to one of the sisters, would you like to sell your building? She said, no, I own it with my twin sister. Make products for the medical surgery. That's their business. I said, can I give you a little flyer that talks about what we do? We buy debt-free and we're happy to lease it back to you. You can stay in the building for as many years as you want. Left. 2 weeks later, I get this call and she says, I'm looking at your flyer. When you came in, we didn't want to sell, but my sister and I have been talking about it. Will you come over and tell us how much you're going to pay and see how the lease back would work? We talked and made them an offer. Time went by. I get a call, Joel, we accept your offer. We'd like a lease back so we can stay in the building. That's durability. Tenant who's been in the building for 40 years and they can't go anywhere. The machines that they've got in this building, you'd say, they can't move any of those machines. They don't and won't. The rent goes up every year to make sure that inflation we're covered. Eventually, one day, maybe we'll sell it, but we don't like to sell.
You went on a podcast talking about industrial's edge over multifamily. A lot of the audience, especially doctors, the main thing they talk about multifamily and apartments. Why is industrial advantageous over multifamily?
First of all, the returns are significantly higher. Multifamily, you might buy at a 5 cap. We don't buy anything for less than an 8 cap. It's a significantly higher level of cash flow, number one. Number two, it is more stable because tenants don't leave. Multifamily, a person can leave in one day and they're gone. They put their stuff in their van and they're out of there. Our tenants can't leave. They've got customers all over the world. They have machines, employees. They can't go anywhere. We buy single tenant buildings. Management is easy. It's easy to explain. Our entire pro forma fits on half a page. The tenant pays the taxes, insurance, maintenance, and utilities. They pay us rent. It's an easy management situation. We have to make sure they're keeping the building in good condition and they pay the rent. We don't have tenants coming and going. We don't have to hire a manager, maintenance people. We don't have to worry about someone getting in a fight in the parking lot with somebody else. It's one tenant, one building, really simple. We're just simpletons. Plain and simple.
Talk about investor minimums, accredited holding periods, returns, and risks to let the investor base be aware of.
Our minimums are $50,000. Most of our investors are in at least 4 deals with us. So most of them have at least $200,000 with us. We have people who have $1 million or more with us over the years, and they're still with us. The holding period is long-term. We believe in long-term ownership. I have 10 buildings in the suburbs of Chicago, west of O'Hare Airport, that we've owned since 2002. So we're talking about 24 years. We have no interest in selling because once you sell, you lose your cash flow. You have to pay taxes. What are you going to do with the money? Wealthy people look at a good investment. They say, why would I sell it? What am I going to do with the money? Go risk it somewhere? When I'm already with you, I've had 24 years of experience. So it's very long-term. I tell people that if you're not prepared to own a building for at least 10, sometimes 20 years, don't go in with us. Our minimum is millionaire.
It looked like the real estate market would get better after May, but looks like Trump threw in a lot of unknowns there with this Supreme Court lawsuit. Now we've got Iran war, the likelihood of interest rates. Where do you see real estate, industrial in general, given the Trump tariffs, the Iran war, oil, interest rates, the economy, artificial intelligence? How do you see real estate playing out with these huge unknown factors?
I've been doing this for 44 years. I've been through 4 downturns. There will be a downturn. It will come one day. It could be in a month or it could be in 3 years. There will be one. I'm a terrible predictor. I've been predicting a downturn for years and it hasn't come yet. So my crystal ball is very fuzzy and blurry. We look at it this way. When rates went up and everybody was shocked that people had floating rate debt and got in trouble, we looked at it and said, we got in trouble in 2008. So we already had our trouble. I didn't want to have more of it. And that's why we don't have loans. So if interest rates go up and everybody else in real estate gets hurt because cap rates end up going up, returns go down, vacancy happens, and whatever bad things happen, we're in a different place. I look at it and I say, it's going to get bad. There's going to be a downturn. It's going to be an ugly downturn. There's private credit risk out there. There's people who've done crazy things, overpaid for things. There's a bubble, in my opinion, going on. I see a crash coming. It may not be as bad as 2008. It may be different. I don't know when, but I'm a pessimist by nature. I think that even though the trend is our friend, they say real estate generally goes up over time. It can go down pretty severely all at once when something terrible happens. The national debt scares the crap out of me. $39 trillion. We haven't figured out how to pay that off. Something's going to happen that's not good. But to answer your question, I don't see the economy thriving over the next couple of years. I see real struggles. I'm probably wrong.
Stagflation. It's ironic. We have a $39 trillion deficit, but we're bombing other countries. That's a different story. The other question I like to ask is, in real estate, how do you see artificial intelligence impacting what you do? Besides automation, making more efficient operations, how do you see AI affecting real estate?
Hugely. I think that what used to be a lack of information before the internet was one of the advantages that real estate people had, is that you could learn a niche and you could know everything about a certain location and a type of product that nobody else knew. AI is going to even it out. In order to be a differentiator, you're going to have information that nobody else has. Whatever's available through AI and publicly is going to take a lot of that inefficiency that's still there. It's going to make it very difficult for people to steal buildings and for people to find crazy things that nobody else knows about. It'll uncover the secret, hidden, buried treasures. That's where I see real negativity. It's going to make it difficult for people like us who like to invest and find something really unique.
What about the entire buying and selling process? It's very cumbersome and tedious. The other day, we were talking about title, banks. How do you think AI will streamline it and make buying real estate fast, easy, cheap, and efficient?
I think it's going to make everything quicker and more accurate. We still have to do our proofreading because it's not going to be perfect.
How can people connect with you and learn more about your firm and reach out to you?
Our website, which is Brit Properties, BRIT, properties.com. It was named after, we sold a company that we owned prior and had to start a new business. We're calling it Brit because our property manager's name is Brad and really is terrific.
Thanks so much for coming on, and wish you the best and keep up the great work.
Thank you.
Let's zoom out. If you're a physician, founder, or high-income professional, and you feel like you're working harder every year, but not structurally freer, you're not alone. The mistake isn't effort, it's architecture. This show exists to help you convert expertise into scalable leverage, faster and with fewer expensive missteps. Here's the diagnostic I mentioned before. If your income requires your constant presence, if your capital isn't compounding outside your profession, if your highest value talent is doing low value tasks, you don't have a growth problem, you have a leverage design problem. And if you want to fix it with clarity instead of guesswork, I offer a limited number of one-on-one leverage strategy sessions each month. We audit your income model, capital deployment, authority positioning, and structural bottlenecks, and design your highest return move. If you're serious about compressing years into months, the link to apply is below.